Welcome to AssetTV. I'm Jillian Kemmerer. Global markets have posted strong performances in recent memory, but investors in the U.S. are still underallocated abroad. Today, I'm joined by experts who trade both equities and fixed income to discuss where they are finding upside around the world. They'll provide macro context in addition to drilling down on the opportunities they're focused on. Welcome to the latest edition of Masterclass. Thanks so much for joining us here today.
Thanks for having us.
Of course. So, Michael, I'm actually going to start with you. You're the closest seated to me, so you're in the hot seat. Over the past couple of weeks, we've had an interesting bit of a global sell-off. So before we were talking about synchronized global growth, which we'll get to, but we've had a bit of a hiccup. How have your key markets been impacted?
So let's think about and go back a little bit into the past. You know, we had a very, very strong 2017. We had a very euphoric January 2018, right? I mean, we all got a little bit complacent. The market were overbought. We had a lot of inflows. So that there is a correction, and I believe that was a correction, not a bear market, is actually a very healthy thing to have. And as I said, I'm convinced that it was a correction and not the beginning of a bear market for a few reasons. Because whenever these things are happening, high volatility events, I do look at certain things. For example, like high yield spreads. This is the first thing. This is for me the canary in the coal mine. If high yield spreads are moving up, then for me, the traffic light from green goes to yellow and potentially up to red. So then the next one, I look at earnings revisions. Earnings revisions have been actually very positive for the first quarter in all of my markets which I cover. So that gets green light as well. And we said before, high yield spreads were also just widening a little bit and even coming back a little bit. Then the next question is valuations, right? Valuations, we're a little bit above medium. I mean 5 to 10%, but it's not a traffic light which goes on yellow or red. And then the last question mark is what happens to bond yields, right? I mean, normally if bond yields are rising a little bit, it's actually a positive thing because you would expect that the economy is doing better, right? So only if they rise too far and too fast, that would be a negative. So, and if you look into the past, over the last 20 years, when we had these high volatility events, we did have actually the 12 months after higher markets than we had today. So from my side, I think we have another little bit to go. If I should quantify it, I don't know exactly, but I would give it another 10% from here. And as I said, in these corrections, I would start buying a little bit.
Well, we were asking last year if no volatility was the new normal. Is volatility the new normal?
Volatility will be definitely higher in 2018.
Now, Michael, you just came back from Europe. Obviously, you do have some focus in your portfolio on Europe. When we think about the ECB, so often we characterize it as lagging the U.S. in terms of their rate hike trajectory. What is the pace that you expect going into this year?
So, good. What I do expect ECB to do is, as you know, we're a little bit later in the QE program. QE was first in the U.S., as you remember, repairing the balance sheet of the banks. And that was a critical part. So that happened in 2008. The ECB was relatively slow, put the foot on the pedal, on the gas pedal a little bit in 2008, 2009, 10. Slowed down a little bit because the Germans were worried about the ballooning numbers which are in the ECB balance sheet. Then in 2015, Mario Draghi, this was the very, very special sentence, whatever it takes, put the gas pedal down fully. So we're in the full ECB expansion program, have brought it back a little bit with the beginning of 2018. And at the end of 2018 or fall 2018, I expect the ECB to stop the QE program. But that doesn't mean that interest rates are going up like this. So I would expect in 2019 the ECB to withdraw the negative deposit rates. That would be step number one, would be very positive for the banks because right now they suffer, particularly the Northern European banks, about that. And then secondly, what I would expect that the first little rate increase in rates will be towards the end of 2019, followed by another one 2020. This is also not that far away from what we see in the Euribor forward rates. So Euribor forward rates are 15 basis points right now for 2019, December 19. And a little bit over 60 in 2020. So I'm not really that far away what the market is thinking. Eric, you might comment on that from the bond side, but that's what I see. And the other part is what is pretty important for us, what would the long-term rates or the long rates like 10 years, in Germany these would be the bonds, the 10-year maturity. I could see that going to 150 basis points, 160 basis points potentially.
So same trajectory, just a little bit slower off of the Federal Reserve.
Absolutely.
So now I want to move over to a valuations discussion. It's interesting because I feel like valuations and stretched, Michael, are the two words that are always going together. Maybe not that long ago we were talking about Europe as cheap, not necessarily the case anymore. When you look out across the global landscape, how would you characterize valuations?
So, I mean, I'm in the camp that valuations are not stretched. Denton was mentioning already several multiples about that. So I think Europe is like 2 multiple points better than the US. But you know, the way how we are basically evaluating our upside potential is coming more from a discounted cash flow model. So higher rates will factor in that we have higher discount factors. But in the past, actually, we have used very high discount rates overall. So we left a lot of leeway for rising rates. So, I mean, from our side, we still find good upside in many markets and in many companies, but we're bottom-up players rather than top-down. But nevertheless, I do think that markets overall, it depends on which valuation metrics you look. I think we're like, as I said before, 5 to 10% higher than medium over long term. So I think we're not, as I said, in the yellow-red zone. We still have a little bit to go.
Approximately when do you think we would get there?
So I mean, it depends on how fast interest rates are rising, right? So if we go into, let's say, 4% on the 10 years in the US, so that would be the equivalent to a 25 multiple, right? For the bond market, I will start getting worried because investors will start thinking about what is my alternative investment. Alternative investment is the 10-year in the US or 7 years or whatever it is, a longer duration. And do I have to go the extra risk in the equity market? So, but I think our core scenario is more that the 10 years move over the 3, but only a little bit over the 3. So, so from that perspective, I'm still somewhat relaxed.
I'm going to ask Danton this in a second, but Michael, is there any place that you would consider cheap right now?
I mean, cheap per se, no. But I think it's we make it more dependent on the company specific. Sure. Rather than on one overall market.
Michael, I saw you nodding your head. Broadly agree with that view that the US dollar might be going down?
Yeah, I'm also in the camp where I do believe that the US dollar will be actually the weakest currency out of all the major currencies. And that is not necessarily for the beginning of 2018. It's more like the more we go into 2019. And Eric, you mentioned something which was really interesting because your point was, okay, we have like higher rates, normally different interest rate differential will dictate actually currencies. But we had now increasing 2-year rates, as you mentioned, and whatever, the bonds and, no, not the bonds, but the 2-year maturities, Germany and so on, is still relatively low. Actually, the spread has widened. It should mean that the dollar should rise.
And it's not.
And it's not, exactly. But I think we're in a similar situation where we have been in 2004, 2006, where we had interest rates actually rising and the dollar not rising. And that is, I think, because people, as you mentioned, are really worried about the overall twin deficits which we will have in the US. And it's getting actually worse. So the more we go into 2019, somebody has to pay for the tax reforms and so on. So therefore, I see that problem coming. And once the QE is not happening in Europe anymore, then also rates will move up, as I discussed before. So therefore, interest rate differentials could narrow a little bit further going into the 19 numbers. I mean, my old core scenario was that the euro could even shoot up to 130, which is good for international equity investing in a way, because your success or your total return is a product of two things, currency gains, and then getting it right in the local markets, whatever the performance is there. So yeah, I mean, currency could be a good tailwind for international equities or international investing in general.
So we have two pretty bearish views on the US dollar and maybe reserve currency status in question too on top of it?
Yeah, I mentioned that once to you, Gillian, when we were talking before. I mean, the further down the road you go, I mean, I do get a little bit of worries on that part too.
Sure.
And I'm definitely not. So we'll talk about that later. I think
perhaps one more thing on the dollar, because I mean what we have seen in the years before, right? All the kind of hunters for yield, right? Went from Europe, from Japan, or other parts of the world, going into the US dollar because rates were higher. So as everything starts to normalize a little bit, what will happen to these flows? And I think flows will be negative for the US dollar into 18, 19. I mean, that's me personally.
Now, Michael, I know that you also are interested in China as well. Would you echo similar sentiments to Danton? What are some of the sectors or industries you like?
China is still one of the faster growing economies in the world, right? I mean, without any doubt. So if GDP comes in at 6.5, but even if it will slow down the road to whatever, 5.5, it's still a relatively strong growing economy, right? And I do agree with Danton clearly that, I mean, they would become leader, and the rest of the world should somewhat worry about it. You know, 5G technology will clearly be in China. The EV project, as you just mentioned, I'm 100% convinced they will win the race because it's a huge market and the government wants it, right? Charging stations are already there, absolutely. And when I look into Europe, I mean, there are some charging stations, but not really. And honestly, the charging stations don't make enough money. That's the reason why some of the utility companies decided, I will wait a little bit until we have higher penetration. And then in China, it comes from the top down and says, you know, we have to have charging station, otherwise the EV will never be adopted. So I mean, I 100% agree on that. And if you look at the worries, what the investors have about China, are these high debt levels. Okay, good, yes, they are 250% plus. We have added 100% over the last, 10 years after the financial crisis, but it's still manageable. Don't forget, I mean, China has a lot of state assets. If they wanted to bring that level down, they could still sell these state assets. And I can tell you for sure, Goldman Sachs, Bank of America, and all of them will line up in order to some of the telecom assets for sale, right? I mean, there's without any doubt. So the other big worry, of course, is the NPLs, the non-performing loans in China, right? And I think the government does the right thing, and restructuring the banking sector, and and bringing more off-balance sheet loans onto on-balance sheet, so where they basically can monitor what is happening in the banking world.
So you're not worried about the solvency of the big banks in China?
No, because what is happening, we are moving up now to 1x multiples, which is good, which allow them without dilution actually to raise equity if they wanted to. I'm not worried about the big four banks, to be honest, because I think their book is relatively good. I'm more worried about smaller banks in the periphery of China, where, like the Northeast, for example, big exposure to the SOE market. And I mean, could they go under? But you know what the government will do? They will nationalize them or merge them into another bank. So therefore, even the NPL issue, I think it's there, but I'm not too much worried about it. So then let's think about it, about the other worries, right? I mean, first of all, in order to make the banks solvent enough, give them enough liquidity, right? So there is the reserve ratio requirements. You can loosen that a little bit, or you have other ways of injecting liquidity into the market, and that's exactly what the central bank in China is doing right now. So I think we're on the right track there. Capital outflows, I'm not worried. We have over 3 billion in terms of reserves. That's not billion, trillion, sorry. Property bubble, which is the other big concern of everybody in China. So yes, I mean, because that's the wealth of the Chinese people, right? The property sector. So the government tries to deflate it a little bit, but very, very carefully in order not to harm them. And if I look at inventories right now in China, inventories are relatively tight. So therefore, I don't expect prices really to tumble. So, and otherwise, I agree totally with Danton. The consumer sector is actually the one which is really, really interesting. And it's edging every single year up a little bit more, and goes at one point, it's a question of time, into the territories where we have it in other developed markets. So yeah, we are also exposed to the consumer place, exactly. And we are also a little bit exposed to the life insurance market.
Now, I want to give you each an opportunity to talk to me a little bit, because you're in such varied markets and such interesting sets of opportunities. I want you to give me, and it can be a country, it can be a single name, an opportunity that you like, and then I want you to talk to me about something you don't like that maybe is perhaps a large part of your benchmark, but that you specifically don't own, and why. So Michael, I'll start with you. What do you like? What don't you like?
I mean, we're not benchmark thinkers, right? So we're clear bottom-up players. We're active managers with a very high active share. So for us, it's all about the companies, and we're not thinking necessarily about countries or sectors or whatever, right? So If you look at our portfolio, it's roughly 50 names, normally very high quality names within this portfolio. And all of them have, and we call it the valuation approach to growth. That's the very important part of us. So we are very sensitive what we pay for it, right? So if that has a good upside, or the discount to this intrinsic value of the company is given, then it will make the way into our portfolio. So, so it's not, we don't like anything which has upside, right? So by definition. We develop this kind of upside via our discounted cash flow models, and I think we do a relatively good job in being for a long time explicit, because we spend a lot of time in the duration and on the magnitude of growth. I mean, that's what we think we're good in, and that is what made us, knock on wood here, or glass, somewhat successful in the past. So you will not get a direct answer.
Okay.
So we will be a little bit more careful. I mean, we do like Europe, we do like China, as I mentioned before. We do like Japan to a certain extent, but very stock specific, and that's where the majority is of our assets. Less so in Australia, less so in Canada, and but as I said, it's a bottom-up approach. And one more thing on China, perhaps. I mean, the development which we had over the weekend, that President Xi is now not only 2 terms in power, he will be 3 or more. That is one of the little worries which I have, and I wanted to add it to in the longer term.
Okay, so Michael, we've come to the end of our discussion, which came up on me faster than expected. It's been such an interesting conversation. So I'm going to issue a 2-pronged challenge in your closing remarks. First, a lot of investors are underallocated to foreign markets in the US, so make the case for the foreign markets, and then tell us a little bit about how Clearbridge fits into that.
Absolutely. So international markets is my preferred place to be, without any doubt. Because international markets are a little bit later in the recovery. We're 2-3 years behind the US. That is true for the developed part as well as for the emerging market part. So on top of it, you have the tailwind from the currency. So I think you will get tailwind from both sides, from the recovery part as well as from the currency side. So therefore, I would recommend to increase the allocation to international markets in general. We at Clearbridge, I told you a little bit about the approach, and that would give you the exposure not only to developed, but also to a certain extent to emerging markets.
And it's not enough just to be allocated to a US multinational that's operating globally. You've got to own the names in those countries.
Absolutely, because you have a purer play, and normally it's more leverage to that particular country or that particular region.
Well, gentlemen, thank you so much for taking the time. You took us around the world in a short amount of time. It was great to hear your perspective both on the macro front and the opportunities that you like. So thank you for taking the time.
Thank you. Thank you.
And thank you for tuning in. From our studios in New York, I'm Jillian Kemmerer, and this was the International Masterclass.